95% of traders lose money. That is not just a statistical fact. It's actually one of the biggest clues the market drops for us. Because if almost everyone is consistently losing, it simply means that the vast majority of traders are looking at the market through the exact same lens. And that perspective is fundamentally flawed. What do most new traders do the moment they open a chart? They look for the basics: support, resistance, trend lines, indicators, and candlestick patterns. Then, they treat the market like a simple plug-and-play puzzle. If resistance breaks, you buy. If support breaks, you sell. If the RSI is oversold, you look for a reversal. If a bullish engulfing candle prints, you go long. On the surface, all of this sounds completely logical. Why? Because these are the exact concepts taught in mainstream trading courses, viral YouTube tutorials, and beginner books. But here's the million-dollar question. If everyone is learning the exact same material, why do 95% of traders still end up losing their shirts? This is where real market understanding begins. The market does not operate like a textbook. The market is an unforgiving ecosystem driven purely by order flow and liquidity. And that is the one thing most retail traders never truly grasp. While retail traders are busy staring at geometric patterns on a chart, professionals are looking at the actual human beings behind those movements. They analyze buyer and seller behavior. They map out human psychology. They study fear, they study greed, and most importantly, they master liquidity. Because in this game, every single major market move is fueled by liquidity. Think about it like this. If an institution, a massive hedge fund, or a whale wants to build a position worth tens of millions or even billions of dollars, can they just hit the market buy button? Absolutely not. An order that massive would instantly violently drive the price up, and the higher the price spikes, the worse their average entry becomes. That's why institutional players are constantly on a hunt for massive pools of liquidity. They desperately need sellers so they can buy, and they need a flood of buyers when they want to sell. Consequently, the market naturally drifts toward areas where the highest concentration of orders rests. And unfortunately, those happen to be the exact spots where retail traders place their orders. Let's look at a classic example. A retail trader opens a chart, spots an obvious clean swing low, and buys. They then place their stop-loss order just a few pips below that swing low. Thousands of other retail traders are looking at the exact same chart and doing the exact same thing. Now ask yourself, what is sitting right beneath that low? It's a massive pool of liquidity. Sell stops, forced liquidations, and panic exits. This is the exact liquidity the big players need to fill their massive buy orders. So, what happens? Price suddenly takes a sharp dive, triggers all those stop losses, fills the institutional orders, and leaves the retail crowd in a panic as the market aggressively reverses and shoots upward. Retail traders scream, "Market manipulation." But the reality is far simpler. The market just went where the liquidity was, because liquidity is the ultimate fuel that moves price. Now, let's flip the script and look at the opposite scenario. Price has been aggressively trending upward, and a crystal clear resistance level has formed. Every single retail trader has their eyes glued to it. It's trending on financial Twitter, YouTube analysts are circling it, and everyone is anticipating the big breakout. Suddenly, resistance snaps. A massive, high-volume bullish candle breaks through. Retail traders get hit with massive FOMO. The breakout is confirmed, and they jump in, thinking price is about to moon and that their entry is safe. But at that exact microsecond, smart money is asking a completely different question. How many breakout traders just FOMO'd into the market? How much buy liquidity is available right now? Because more often than not, that highly anticipated breakout is the perfect entry for retail, but the ultimate exit liquidity for professionals. This brings us to a critical rule. The market rarely rewards the obvious. Obvious setups are visible to everyone, and wherever the crowd gathers, massive liquidity pools form. Where liquidity forms, smart money strikes. This doesn't mean every single breakout fails, or that support and resistance are useless tools. Not at all. The issue isn't the tools, it's the interpretation. Retail traders blindly trade trade signals. Professionals trade the entire macroeconomic and structural context. If price action is the visible story of the market, volume is the hidden truth. Price tells you exactly where the market went, but volume exposes how much true participation was backing that move. It shows how many buyers and sellers actually bought into the idea, and how much real conviction exists. This is why professional traders never analyze price in a vacuum. They constantly weigh the relationship between price and volume, because it's highly common to see price drifting higher while volume is rapidly drying up, signaling a completely different reality. Volume is the literal heartbeat of the market. It drops major clues about institutional footprints, retail crowd participation, and the true underlying strength of any trend. The foundational pillar of volume analysis is effort versus result. Here, effort represents the volume traded, and result represents the actual price movement achieved. Your internal question should always be, how much actual price progression did the market achieve relative to the sheer amount of volume effort poured into it? Let's talk about stopping volume. This phenomenon typically prints near the absolute end of a brutal, prolonged downtrend. It's the precise moment when massive panic selling floods the market, yet the price stubbornly refuses to push significantly lower. On the surface, it looks like the bears are completely dominating. But beneath the hood, smart money is actively stepping in and absorbing all that panic supply. You can easily identify stopping volume by three distinct characteristics: a violent price drop, unusually massive spike in volume, and an absolute lack of bearish follow-through. On the flip side, we have the buying climax, which usually shows up at the tail end of an extended, aggressive uptrend. This is the ultimate peak euphoria phase, where FOMO and hyper-bullish sentiment grip the retail public. Price accelerates near vertically, volume explodes to extreme highs, and the masses genuinely believe the rally is just getting started. In reality, this is almost always the exact window where smart money is quietly and systematically distributing their massive positions over to eager retail buyers before exiting the building. Then there is volume divergence. This happens when price and volume stop validating one another. For instance, if price keeps printing higher highs, but volume is steadily making lower lows, it's a glaring warning sign that the rally is running out of gas. Similarly, if price keeps grinding out new lower lows, but bearish volume is diminishing, it tells you that institutional selling pressure is completely exhausted. The hard truth is that the vast majority of retail traders jump into the markets without an actual, defined process. They open a chart, catch an impulse setup, execute a trade, and then spend the next few hours managing that position purely based on raw emotion, changing their minds with every tick. Professional traders operate like machines. Long before the opening bell rings, they have already mapped out key structural highs and lows, major liquidity pools, and multiple detailed if-then scenarios. Their exact entry triggers, invalidation stop losses, position sizing, and profit targets are locked in before the trade is even alive. They aren't in the business of predicting the future. They are simply executing a highly disciplined process. At the end of the day, even the most legendary trading strategy won't save you if your risk management is garbage. Professional traders never focus on how much money they can make if they're right. Their hyper-focus is always on exactly how much capital they are willing to lose if they are wrong. They treat risk like a strict business expense, taking mathematically controlled risk on every single setup and making capital preservation their absolute #1 priority. As we've broken down in this video, the masses don't fail because the market is an impossible math problem. They fail because they insist on looking at the market the exact same way the rest of the herd does. They blindly chase lagging signals, completely ignore the broader market context, fail to understand the mechanics of liquidity, and let raw human emotion hijack their execution. Professional traders think entirely differently. They pull back the curtain to decode the hidden liquidity, volume signatures, and institutional behavior behind the raw price prints. Remember, your job in this market is not to play profit and predict the future. Your job is to calculate probabilities, strictly manage your downside risk, and execute a flawless, disciplined process. The exact moment you stop thinking like the crowd is the exact moment you stop getting the tragic results of the crowd. And that right there is where your evolution from a retail trader to a true professional finally begins.